Hi, Steve Van Metre here. Welcome to your weekly economic update, where we take about 30 minutes every Friday to try to make sense of some irrational, highly volatile markets. And just for clarification, tonight's video will probably go longer than 40 minutes because I'm going to convince you, without a shadow of a doubt, the Treasury yields are going to zero. I'm going to show you exactly why. Who's going to do it? I can't tell you when, but it won't be long before they do. I'm going to show you why the stock market is going to crash, why those who own bonds are going to have the biggest opportunity to buy risk assets in their life. And we're going to do this right now. Now, for those of you who are new, that's a pretty bold claim. For those of you who are regular watchers, my clients, you know that I've been talking about Treasury yields and bond prices for a long time. And there are some claims that I have made, which was that interest rates would see new all-time lows. They have. I said eventually the stock market would puke on itself. It is. And no, it's not over. No, not over. I have said the cause of this was not the coronavirus, but it is the tipping point. And I'm going to make some more bold claims by the time we're done that will probably come true. So why do I consider myself so knowledgeable about bonds? There's a lot of people that know a lot about bonds, and they're all pretty much wrong. See, I studied and learned from the same people you did, and about 99% of the people, 99.9% of financial professionals at all levels do not know how the bond market works. They absolutely do not. They think they do, and they are consistently wrong. I am not the foremost expert on bonds. That would be Dr. Lacey Hunt of Hoisington Investment Management. There are other experts who are dead. I've studied Lacey's research. Those who are dead research, who are experts. I've studied the monetary system, and I've come to the conclusion that I am one of the few people who actually understand how it works. Now, I could just simply say, well, Treasury yields are going to zero, and click stop, but I don't do that. You listen and tune in to my videos because I show you exactly how. I want you to learn. So let's get started. And I have no idea where this whole thing is going to go or how long it's going to be, but you're going to learn a lot today. I promise you it's probably going to be one of my best videos ever. And then when I get done, I'm going to think about all the things I missed. But I made a list. And I want to thank my friend and client in Texas who encouraged me to bring back my Q&A session. Well, my friend, I've got 2 pages of Q&A, and I know his wife and his daughter are watching, and I appreciate them very much. So let's roll through these questions, and as we go through it, we're going to start answering the questions of why Treasury yields are headed to zero, because it's a big question. You say, well, why do you care so much of that? Well, because my clients are invested in Treasuries, and my portfolios are hedged with Treasuries, and everybody thinks they're going to go down in value, and I say they're going up, and way up. Let's deal with the very first question that no one has asked me today because I haven't gotten a call since the market closed. And that is, why did stocks rally so hard into close? It's really simple. Sports, all suspended, canceled for who knows how long. Schools are closing. People are getting concerned about the coronavirus. They're obviously at the grocery stores today, Costco, Sam's Club, all over the country buying up everything, particularly toilet paper. So why did the market need to close up today? Because what do you think people are going to do this weekend? They're going to be thinking about not going places and not doing anything and not watching sports. So somebody is going to start looking at their investment accounts. And they're going to have all weekend to stew over that. And there's a high probability if the Dow closed down 1,000 points today, which it did not, but had it done that a lot of people would stew over to the weekend and push the sell button. That's why it needed to close up. Because what you may not understand is the stock market is a proxy for consumer spending. You want to know what the consumer is going to do in the months to come? Look at the stock market. When it goes down, consumer spending goes down. Housing prices go down. Everything goes down. And if you don't believe me, imagine all the people out there that are retired. or maybe near retirement, within a few years of retirement, who have been convinced by themselves, their financial advisors, and in the whole industry that I exist in, to load up everything they have in stocks because this is going to be the biggest bull market ever. And now they're going to pull up their statements and see they're down 25%. If you're retired, do you think your spending is going to stay the same? No. If you're on your path to retirement, do you think your thoughts of when, how, and what you're going to do in retirement are the same? No. All of a sudden, you're not going to go buy that second home. You're not going to buy that new car. You're not going on that fancy vacation. You're not going to do a whole lot that you were because you have 25% less of your money. So this is very serious what's going on. And again, as I said, I also convinced you the coronavirus did not cause this, but again, it was the tipping point. Okay, let's go through some questions, and let's get to this. Now, many of these are questions that came in this week. Some of these I added on to. I think they're all relevant. I've gotten a lot of questions over the week, and I think this is a great format to answer them. What tools does the Federal Reserve have? They have 3 tools. They can raise and lower the federal funds rate, which they do by buying or selling U.S. Treasury bills. They can increase or decrease their balance sheet, which they do by buying or selling U.S. Treasury securities, and they have the authority to buy an unlimited amount of Treasury securities. Literally, the Fed could buy every single U.S. Treasury bill, note, and bond tomorrow if they wanted to without any approval from Congress, the president, and any branch of the government. They have full autonomous authority to do that. They can also do overnight and term dollar loans, but those must be paid back. That is the extent of what the Fed can do. They cannot do anything else. Now, the next question is, because you probably heard, and somewhere in these questions we'll probably address that, is the Fed injected $1.5 trillion between Thursday, Friday, and this next Monday. No, they didn't. Actually, they had $500 billion worth of term dollars. I believe they're 90 days. It doesn't really make a whole big difference how long they are. And believe me, not many people really interested in them. But are dollar loans inflationary? There's absolutely no evidence they are. None. Nope. How does inflation occur then? Well, that's simple. Only banks can print money. That is, in our monetary system, the only, I was going to say mechanism, but the only entity that can create money are banks. And how do they do it? When a new loan is originated. So if you go down and borrow money to buy a car, new money is created. That's how inflation occurs. It does not, the Fed does not, I'm sure it's in here, the Fed does not have any mechanism to create inflation. In fact, if you go back in history, this is the third central bank we've had as a country. The Fed was created to fight inflation. Now, when they created the Fed, they believe that all paper currencies, fiat currencies, are inflationary, which is absolute fact. If you create a fiat currency, plant it in the ground, it will hyperinflate at some point in its future. I mean, that's what they're designed to do. Partially why people like cryptocurrencies. Not that I'm endorsing them. I'm just saying there's a reason people are looking at alternatives. And I'm not suggesting, that you do that. Just saying that's a reason. So when the Fed was created, it was never given the tools to create inflation because they didn't believe that was an issue. They believed inflation would just happen. So the Fed is constantly trying to create inflation with tools that are only designed to remove inflation, to destroy it. That's why the Fed can never create inflation. All right, are low interest rates inflationary? No. No, how can they be? No. Look, we've had declining interest rates for 40 years. Have we had inflation? No. Yeah. Okay, I know some things are going up, but in a broad scale, are we having just rampant hyperinflation after 40 years of low interest rates? No. Why? Because low interest rates are disinflationary and potentially deflationary. But low interest rates can be inflationary in the short term, depending on how much money is created from new loans. So when interest rates fall, and a lot of people go out and borrow money and injects all this money into the economy, it appears to be inflationary. And then once demand for loans at that interest rate level subside and people are paying back those loans, it becomes disinflationary until it becomes deflationary. So they are in the short term. Now you have, well, what's short term? Could be 30 days, could be 10 years. It is short term in the grand scheme of the monetary system. So ultimately, low interest rates are disinflationary. And as I said, for 40 years, we've seen falling interest rates, falling inflation. You can chart the two together. They're going to follow each other. So aren't negative interest rates inflationary? No, they're not. They're really deflationary. And if you don't believe me, go look at Europe, Japan, and everyone else that has negative interest rates. Are they experiencing high rates of inflation? No. Will the Fed dollar loans work to reignite the economy? No. No. And not only no, but they haven't. This isn't the first time we've done these dollar loans. We did them before the great financial crisis, and how well did that work? Yeah, it didn't stop the great financial crisis from happening. Why not? Well, simple. Dollar loans do not increase world dollar liquidity. Which world dollar liquidity? I'm glad you asked. World dollar liquidity is the global cycle of U.S. dollars. Let's review, and I did fix the arrows for those of you who've seen this before. But it's important to understand, because I'm going to outline how we have made, as a country, a series of mistakes. And I hope, please understand that nothing I say on this video is political or has any direct opinion against whoever or whatever party is in power. I have said, as we have done some of these things, that they are mistakes. It was not an attack on any politician at all. Believe me. Politicians make plenty of mistakes, like everyone else. So it's often, the problem is they don't know when they're doing it what the long-term effects are. Neither does the Fed, so I can pick on them equally as well. But let's take a look at the world dollar liquidity cycle. And here's what it looks like, and here's how it starts. Consumers buy foreign goods. So let's just use my son as an example, who now sells Volkswagens. He went from selling Audis to Volkswagen, same dealership. He sells a Volkswagen. So you want to buy a Volkswagen, you go down and you buy it from him, and that is a foreign produced good. So there are dollars. Yes, some of them stay here, but when you buy that car, some of them go back to Germany, to the parent company. So dollars flow to foreign companies. Now, after a while, that company piles up a bunch of dollars it doesn't need, because guess what? You cannot pay your workers in the European Union in dollars. So then they say, hey, we got too many of these dollars. They go to the European Central Bank and exchange those dollars for local currencies, or euros in this example. And then the European Central Bank starts piling up these dollars. And well, the more fiat currency you have, the more inflationary it is. So guess what you need to do? You need to get rid of it. Well, not all of it, but some of it. So then when the U.S. Treasury has an auction for debt, well, the foreign central banks come in and buy it. Because guess what? If you have, say, $1 billion worth of dollars you want to get rid of, and you buy $1 billion worth of U.S. Treasury securities, those U.S. Treasury securities are not inflationary because they don't expand themselves. Right? They don't multiply. You put dollars in a bank, people can lend against it. You put a treasury, well, you can borrow against treasury securities, but they themselves are not overly inflationary. The inflation comes from the interest payment, which is minor compared to what you get by putting dollars in a bank and allowing people to lend against it. So they buy U.S. Treasury securities. Then those dollars come back to the United States. Notice we're flowing dollars from the U.S. all the way back. And so now it's in the hands of the U.S. government. And we know the U.S. government wants to deficit spend, but in the name of this cycle, it needs to deficit spend. The U.S. government must perpetually run a deficit, which is partially why Congress could care less about the deficit to the extent of how big it is. And foreigners, governments, care about our deficit to the extent as they want us borrowing to create demand and put things into the economy. So consumers will buy more foreign goods. And this cycle repeats. And as it repeats over and over and over again, the number of dollars in the global economy gets bigger. And in a fiat debt-based economy, global economy, as the expansion of dollars get bigger, that's why your housing prices go up, your stock prices go up, your car values go up. That's why things go up in value, because expansion of the fiat currency through the world dollar liquidity system. Okay? Now, let's talk about the mistakes we made. Oh boy, this is fun. All right, so first, who was the first person that made the mistake? That would be the Federal Reserve by tightening monetary policy. So what did they do? Starting in December 2015, they raised federal funds rate, and then in 2018, I believe it was, they started selling off bonds in their balance sheet. And the Federal Reserve destroyed the largest number of dollars in the global world dollar liquidity system in history. This was the largest tightening cycle in history. Now, the problem with what they did is in a debt-based economy, you should never, ever, ever do this. Remember, you have to have this perpetual expansion of dollars. But the Fed gets afraid of, oh, look, the dollars are expanding too fast. Temporarily, yes, they will do that. And so they said, we need to slow that rate of inflation down because they're going to mushroom out of control. No, they won't, but that's what they did. And so they tightened monetary policy. And the problem with monetary policy is it has variable lags, which cannot be calculated, but are estimated to be now about 2 years in length. So things we did 2 years ago, back in March of 2018, are affecting us now. So we were in the early stages of the Fed unwinding their balance sheet. So they were the first person. So this is why, when I say the coronavirus didn't cause it, there's a reason Japan is pretty much in a recession in the fourth quarter. The European Union but the data said they were entering it, and we were starting to slow down. It was all because the Fed started to contract world dollar liquidity years ago. Now, the second mistake we made was the tax cut, the Tax Cut and Jobs Act of 2017. I was very much against this because, one, it was deficit based. So we had to borrow money for the tax cut, meaning it would not have a long life in terms of domestic economy. But in terms of domestic economy, I could care less. In terms of world dollar liquidity, it hurt world dollar liquidity because the focus here is world dollar liquidity. The real issue here is not all this other stuff going on. It's how it affects world dollar liquidity. So how did the tax cut affect world dollar liquidity? Simple. Do you remember when President Trump said, hey, we want to encourage corporations to take the money they have parked offshore and bring it back to the United States? Do you remember that? And he's not the first president to do this or want to do it. They all see those dollars over and they go, God, if we just bring those back. The problem is those dollars need to exist there in banks to provide the funding mechanism for loans and dollar demand. But we brought them back and we used them to, corporations mostly used them to buy their stock back. So so you have the Fed that contracted world dollar liquidity, and then the tax cut contracted it some more, okay? Now, mind you, you can only do this so much before the global monetary system starts to fail. And then you get to a global recession, and if you don't fix it fast enough, you start to point yourself in a global depression, which now you look at what the coronavirus is going to do, you can kind of see where I'm going with this. What was the next mistake we made? We entered a trade war with China. Again, I said, no, we should not do this, even though on the other half, I knew why we were doing it. I understood, and I have said that before. I understand exactly what President Trump was trying to achieve. The problem is when you do not understand world dollar liquidity, you realize you shouldn't be doing certain things. And so what did we do? We put tariffs on China. And what did that do? That slowed global trade. Well, we could go back right here and we can say, well, where did that hurt? Oh, we drove up the prices of things, so Americans bought less stuff. Okay, well, guess what? We then another layer of contraction of world dollar liquidity, and even though we pulled some of those tariffs off, much of them still exist. Okay, next, we had high oil prices. Okay, I understand. High oil is very, very good. Don't get me wrong. I'm not suggesting we want low oil prices. I can prove to you we don't want low oil prices. But what high oil prices did was enable U.S. shale, which is very, very expensive to produce, to be profitable. And in the world dollar liquidity system, you want foreign companies to be the leading oil exporters and export to the United States. That's how the system works. It's the way you want it to be. But when the U.S. starts becoming the number one oil exporter, you contract world dollar liquidity again. And so then you get low oil prices. And what happens to U.S. Oil companies who do exploration and spend massive amounts of money, not only in the domestic economy, but the global economy, producing and refining oil? Well, they cut back and stop. So it's a double-edged sword. High oil prices contract world dollar liquidity, and low oil prices doesn't help either. Ideally, from world dollar liquidity standpoint, you would not want the United States to be in the top oil exporters. You really wouldn't do that. Again, it just is how the world works. So again, we have layer of contraction in all world dollar liquidity. And what's the next step that happened? The coronavirus. You're like, okay, how can the coronavirus be a problem for world dollar liquidity? Really simple. Consumers buy foreign goods. Now, just because you go on to say online retail and order something, Have you ever thought about what happens when you get on a cruise ship, for example, and go to a foreign country? And you get off the boat and you go on an excursion and you convert those dollars to foreign currency. Maybe you're flying to Europe or Asia and you hop on a foreign airline. Dollars are getting dumped into the global economy. And you land there and you convert your dollars to local currency and you go spend it. Or you use your credit card, which converts your US dollars to local currency. All spurs an expansion of world dollar liquidity. But you didn't think about that. Pretty cool, huh? So what happens due to the coronavirus, as global travel goes to nothing, it makes that final contraction of world dollar liquidity that took that domino that was just wobbling to begin with and goes, doop. That's the issue at hand, is world dollar liquidity. And if you look at the chart, excuse me, here's where we're at now. Consumers aren't buying as many foreign goods. As many dollars aren't flowing to foreign companies. Dollars aren't being exchanged as much to local currency because we're right here in the problem now. What did we have this week? We had some mediocre demand from foreigners in U.S. Treasury auctions. This is the final stage of doom. Now, I know what you're thinking. Okay, that means yields are going up. No. Temporarily, maybe, but not more than that. There's not more than that, because there is one hero that can come to the rescue. And let me pull up some charts and show you who and why they're going to do that. And no, I don't have the coronavirus. I mean, who knows? I might, but that's not. My cough is not a symptom from it. It's from a fungal lung infection that I've had for a long time. Here is world dollar liquidity. It is the sum of federal debt held by foreign and international investors plus the monetary base, which is pretty much all currency in the U.S. And here it is. It was contracted. Let me change this from a year over year rate. And you can see here this contraction. Never ever really have we contracted. Here we're doing QE, so we didn't. This largest contraction here, not only does it have to get pushed all the way back up here, it has to keep going. In fact, if you draw this like a curve, the world dollar liquidity needs to be somewhere up by this download button. So the Fed contracted this, and then all these other things are just mitigating circumstances to make it worse. Now, if foreigners are not buying as much debt because they don't have dollars because global trade is contracted, that means the only solution is the monetary base. Okay, cool, right? I'm going to teach you exactly how it's fixed and who's going to fix this. So, the Fed has three tools. One tool allows them to raise and lower their monetary base. Whoops. And they can do it by massive amounts of quantitative easing. And how massive? Oh, they're going to make QE 1, 2, and 3 look like a joke when they have to get this started. A joke. And I'm telling you this because they increased their not QE program from $60 billion a month today to $80 billion per month and extended this purchase across notes and bonds. $80 billion a month is going to be child's play compared to what they're really going to have to do. Because let's revert. Look, I want you to critically think about it. How do we fix this problem, right? So the problem is consumers need to start buying foreign goods again. What will it take Americans who just had all their 401ks and IRAs whacked by 25% or thereabouts to buy foreign goods again? No, not giving them money, lowering interest rates. The Fed has three tools. Those tools only do the same thing. They can effectively raise and lower interest rates. They can do nothing else. So how do we get consumers to spend money? We lower rates. That's why rates have dropped for 40 years. That's why quantitative easing causes interest rates to go down. It's really simple. There's a relationship. Bond prices go up, interest rates go down. This is a static relationship. So when the Federal Reserve comes in and buys bonds, what do they do to the price? They push them up. And what does that cause interest rates to do? Go down. You think, oh, but Steve, you're a complete idiot because during QE, interest rates went up. Okay. Did they? Are you sure about that? Are you sure? Because here you go. Here is the monetary base against 10-year Treasury yields. QE1, up, drove the monetary base up. And look, 10-year Treasury yields were falling, popped up, sound familiar? Fell. Everyone said not going to happen, popped up, happening right now. This is exactly a replay of what's going to happen. Fed panics, turns on the massive QE engine, and boom, interest rates collapse. There you go. But I thought they rose. Well, they after they got down here, it created lending growth and some demand in lending growth, and that caused money to be created. And then look, interest rates went down because the Fed stopped doing QE. World all liquidity started to slow down. And so they did some more. They said, oh, well, look, it went up there. And then it went down because that's what it does. There's a lagged effect. And then it went down to new all-time lows. And then the Fed said, gosh, we got to do QE3. Oh, look, QE3, there it is. See, it went up. Yes, because part of the reason is President Trump won the election. Everyone said it was going to be inflationary. And guess what? These low rates did create lending growth demand, at least in the housing market, caused rates to go up. And then as it's going up, guess what? The lags kick in and boom, new all-time lows. And then they went up again because those lows were caused. I'm sorry, this isn't when President Trump got elected. He got elected here. But what happens is interest rates fall enough to create lending demand. This is how money gets created. And that creates higher interest. Here's where President Trump got elected. People dumped their bonds. Interest rates went up. And monetary base went down. But financial conditions were tight. Interest rates fell. And now look right here. The monetary base is rising because the Fed is cutting rates and doing QE that's not really QE. And look what's happening to rates. They're falling. Guess what's going to happen when this thing keeps going up here? They're going to drive rates down. And at the same time, they're going to kill the stock market. Look, when the Fed did QE, boom, there goes the stock market. QE2, boom, there goes the market. QE3, aha, we got them this time. Well, it lagged up here. It wasn't until they went crazy that they could keep the stock market going. So quantitative easing is bullish for bonds, bearish for yields. There's no way around it. It's just how it is. All right, next question. How can world dollar liquidity be restored? Either global trade, as we now know, or the Fed is going to buy so many bonds that you're going to be shocked. Isn't QE inflationary? No, but investors think so. QE lowers rates, as I showed you, until lending demand increases, and then the new money is inflationary. Let's talk about that. Because I'm saying the interest rates are going to go to new negative, probably in 10-year Treasury. And they're going to be there for a long time. How can that be? Well, this is a demographic issue. Okay? Think about it. You've got the baby boomers who half of them are in retirement, are over the age of 65, effectively in retirement. Half of them are not. They've just had their brokered retirement accounts eradicated by 25%, thereabouts. Now, what do you think they're going to do in retirement when interest rates go down again? Are they going to borrow money and spend it? No, they're going to borrow money, lower their monthly expenses, probably extend some of their loans out, and call it good. Now you have Gen X, my generation. We're smaller, and we aren't borrowing like everyone else because we've been through recessions. You know, I graduated high school, there was a recession. 6 years later, there was a recession. And then 10 years later, or 8 years later, there's another one. Look, Gen X is the most skeptical generation. We don't believe about these infinite economic expansions fueled by the Federal Reserve. We live through it. We don't buy it. Unfortunately, the boomers have not been convinced of that. This time they will be. Then we have the millennials who are already saddled up in debt, don't know what a recession is, and think the Federal Reserve has figured it all out. Wait till they get hit. So the question now becomes is, interest rates have to go so low to get the boomers to borrow, which they're not, to get the Xers to borrow, which they will some, but to get the millennials to take over not only all the debt that's being paid off by the boomers, but to create even more debt. And so to get millennials to buy homes and cars and all these things, not only are prices going to go way down, but interest rates have got to go down. And the Fed's going to do it. The Fed is absolutely going to do it. All right. Let's see. But QE was inflationary. First half of QE1 wasn't. The Fed does not have the tools to create inflation. They don't. We covered that. But there was inflation in the 1970s, yes, because we devalued the dollar. Okay, well, won't we do it again? Well, I'm probably, but I don't know how, because the dollar used to be pegged to gold. It is not pegged to gold anymore. It's pegged to other currencies are pegged to it. The only way that anyone can think of is the way this will work is if other currencies are allowed to appreciate against the dollar. Good luck. Seriously, that's not going to happen. Why is the Fed running these huge dollar loans? Again, they only have 3 policy tools. So they're lowering rates, it's not working. Their QE isn't working. So let's do some dollar loans because, hey, no one seems to be bothered by those. They don't work. Interest rates go, yes, down. 10-year treasuries are going 0 or negative. Fed will buy bonds and drive rates down. Federal funds rate to 0%. Yes, it's going to happen on Wednesday, if not sooner. All right, so a question that comes up is, how can the federal funds rate cause treasury yields to go down? Well, did you draw a chart of it? I did. So here is the effective federal funds rate in blue. And look, when the federal funds rate goes down, look what happens. 10 and 30-year, 10 in red, they're almost identical, go down. You can see it right there in the chart. Fed funds rate goes up, yields go up. Fed funds rate goes down, yields go down. So here you have federal funds rate going down. Yields are already going down. The Fed's going to go to 0. And the mechanism for that is they have to buy 60 to 70 billion for every 0.25% rate cut of treasury bills. So that means they're going to buy somewhere between $240 and $210 billion worth of T-bills after they announce this cut on Wednesday. Let that sink in. So when someone tells me interest rates go up, when the largest buyer of treasury, who has the most money available to them, the deepest pockets, is going to come in and buy them, you got me. But doesn't that liquidity get in the market? No. Did you draw a chart of that? I did. Here we go. So here is the federal funds rate. When the federal funds rate goes down, markets puke. You can kind of see, you can barely see the recession here. Here the federal funds rate goes down, market pukes. Federal funds rate's going down, market is puking. I told you that's how it worked. And so there you go. All right, next question. How far will stocks fall? Farther than you think. Yeah. No. Yes. No. Yes. Okay, I'll show you. Let me bring up next chart. Is who, so you got to ask, who's been the largest marginal buyer of stocks over the last 10 years? Hang on, let me bring the chart up. And it has been corporations. So look, foreign investors, really not major buyers. Households, net sellers. Think about it. The baby boomers, half of them are pretty much retiring at 65. Half of them are 65 and older. Net sellers. Insurance and pension companies. Gee, what a surprise. Boomers are retiring. Net sellers of equities. And corporations massively buying. The largest buyer of stocks are running out of money right now, folks. And let me tell you this. As of what we know today, which is not fully current, is corporate share buybacks have been cut in half and are every week as the coronavirus and the global economy slows, they're going to go down more and more and more. Why do you think the stock market's falling so much? It's not because people are really selling. Look at the trading volume. It's because the largest marginal buyer of stocks is disappearing. That is why. Let's see. Due to the coronavirus, they aren't buying that much. Yeah, okay, there we go. But surely stocks can't fall that much. Oh, sure they can. Look, do you understand what corporate share buybacks did? They took this huge pool of shares that was out in the market and they shrunk it down to the smallest level it's been in many, many decades. There are fewer shares right now than there have been in such a long time. And there's fewer listed companies because what have we had due to these zero interest rate policies of big companies buying up little companies? So guess what? All your friends own the same stocks you do because they're the only ones to buy. And guess what happens when everyone sells them? There's no buyers. That's the problem. I've been saying this is going to happen. All right, so everyone sells, the market will crash. When will I buy stocks? Well, when volatility peaks, I'll sell bonds to buy stocks. Or like I say, I'll buy when you're selling. That's true. But the stocks have got to go down a lot. You know, I can show you that this was predicted. I predicted this a long time ago because here, look, you have the S&P 500 in purple. I told you this video is going to go all over the place, right? Here's the S&P 500 in purple. Here's Treasury yields in this red and green line. And here's how it works, all right? This is exactly how it works. Stocks are in green because everyone loves stocks. Yields will be in red because no one likes bonds. When the markets go up, let's see, there's the angle, they trend together. In bear markets, they trend, actually it would be this way, they trend down together. Okay, at the peak of bull markets, what happens is yields start to fall while stock prices still rise. So we got this going on. And about 3 months later, this happens. Now, it didn't happen this time. Okay, let's go look. Why did it not happen? Well, because what did happen in late 2018? Tax cut, or the tax cut put this bid of corporate share buybacks under equities. It should have. It started to roll over right here. You can see it rolled over. It was starting to roll over, and then boom, more share buybacks. So look, now how do you know the market is bottom, and how do I know that yields haven't bottomed? Well, that's easy too. Because when you study the monetary system and how this stuff works, you figure out that stocks will start going up. Wait a minute, is that right? I'm not good at this. Stocks will start going up while yields continue to fall and bottom. Now, why would that be? Because who sells most of the stocks at the bottom? The retail public. And what do? They buy bonds. That's why stocks go up when yields keep going. That's why we know we're not at a bottom, because yields haven't bottomed and stocks aren't really rising, and no, one day doesn't count. So what we have here is that stocks, this was going to happen anyways, and stocks need to go way down. Now, I'm not saying they're going to go down to 1,300. They might. I doubt it. But they're going to come way, way down. And the further the Fed drives yields down, the further stock prices are going to fall. It's just how it's going to work. Okay. Why did bonds go down this last week? How about the better question is, why did they go up? So let's go look. Let's get this. I told you were going to learn a lot this video. I really want you to understand this stuff. So what happened here on this very day? The Fed cut the federal funds rate by 50 basis points. And when they do that, they immediately begin to buy it down by purchasing T-bills. So they would have gone out and purchased somewhere between 120 and 140 T-bills starting that day. That, causes yields to go down. Now, what else did they do? They bought around $21+ billion as part of their monthly $60 billion asset purchase program, and they drove yields down. And they squeezed short sellers out. And those short sellers came back in after getting squeezed out. And some funds started blowing up, some like hedge funds and some risk parity funds started going nuts. And it drove yields all the way back up to here. But you'll notice, despite all the hoopla about yields going higher, they really stopped right, where the Fed was buying. And why is that? Because the Fed puts a ceiling on bonds. Look what happened over here. The Fed cut rates and they went down. And then they tried to come back up, Fed cut again, and they went down. And then, they got up behind this one. And yes, everyone said bullish in yields. Look. And nope, down. The Fed limits how far this can go by cutting rates. And now you're pretty much looking at right in here as the peak. And next week, what's going to happen? On Monday, $33 billion of Treasury securities that the Fed bought today settle. There you go. Now it's going to enter the market. And on Wednesday, they're going to drop the funds rate to 0. So there you go. You're sure interest rates will go down? Yes. Yields bottom after stocks. Unemployed people are losing their jobs. They're going to start losing their jobs. We're in a gig economy. A lot of people are self-employed. Do you understand how many people are marginally employed that would work evenings and weekends at, say, sports arenas and in the travel industry to make a few extra bucks? They're not making that now. Unemployed people don't get loans. You want to see when interest rates really go down? Wait till the unemployment rate goes up. Isn't this crash because of the coronavirus? No, it's due to the contraction of world dollar liquidity. How could you have known? Because the bond market predicted all of this back in October of 2018 when yields started to fall. All right, now let's get on to the regularly scheduled program. I told you this was going to go a long time. That's over to, here, oil prices let's talk about this. Oil prices going down. Here is GDP growth going down. Oil prices go up, GDP growth up. Oil prices go down, GDP growth goes down. Trump said he wanted low oil prices. I said, no, he didn't. And then what happened? He came out today and said, oh, by the way, we need to, we're going to buy a lot of oil and fill up the strategic petroleum reserve. Somebody figured it out. All right, we went over world dollar liquidity. How about the NASDAQ McClellan Summation Index? Proxy liquidity is back where it is, where buyers came in. If we see some buyers, don't expect that to last. The global economy is contracting. And let's look at the holdings of banks. We have treasuries and bank credit. Big jump in bond purchases by the large commercial banks. Big. I'm going to have to, let's pull up the calculator here. 39.46 minus 38.79. They bought $67 billion in 1 week, and they bought right up to the bottom of yields. I told you the banks are behind this. There's a reason why yields are not going to keep going up. And look, they bought a bunch of mortgage-backed securities, a bunch of U.S. Treasury securities. There you go. Looking at all loans and leases, the commercial banks, that jumped quite a bit. Looks like about a little less than 40 billion. Not commercial industrial lending though. I thought it would come in real estate, 9 billion in real estate loans. Not much in commercial, but 6 billion, but still a decent amount. And looking at consumer loans, here's what scares me. Credit cards went up 8 billion. Obviously, we know people are going to the store and buying stuff. Question is, can they pay for it? Not seeing any much growth in auto loans or other debt. So there's all of that for you. Now let's get on to the charts. Let's got to reload them here so we can see, and switch that to, here we go. Here's the M2 money supply. Growth rate is flat at 7.22. 6-month rate change, 3-month rate change, both flat. How about real estate loan growth? It says flat up to. Well, we need to fix that. It is not flat up to. That's not possible. It is, up to 4.45% from a year ago. Can you see that good? 6-month rate of change is flat. 3-month rate of change is falling. How about commercial industrial loans? I said don't mind the back end data. Growth rate is down to 105. 6-month and is falling. Actually, the 3-month rate of change is falling too. I'm not going to edit that. Loans and leases at all commercial banks. 1/3 of all loans in the country. Growth rate is up slightly to 4.44. The 6-month rate of change is at 2.2 and rising. The 3-month rate of change is 0.8 and flat. So nothing going on. See, these low rates are not creating inflation. How about consumer credit card? Bam, big jump, 5.44% from a year ago. We obviously know that it has to do with people panicking about the coronavirus and potentially not having as much income. We did that. Okay, on to some charts. So the S&P 500 gets back into this zone of resistance after this big, giant surge today. Is still way down and stuck into resistance going back here. Don't expect this to last at all. I expect this to reverse and go down. Volatility did come back off its, wildly high at 77. If we go back to the this is almost great financial crisis level and nothing has broken yet. Don't worry, something will. And when it does, it's going to be ugly from the volatility perspective. And the Fed, as they ease, drive volatility up. You say, no way, Fed can't be that dumb. Oh yes, they can. Let's overlay 3-month treasuries, IRX. And there you go. Look, when the Fed cuts rates, spike in volatility. So, man, can you imagine what volatility is going to do when they continue to cut? It's going to eviscerate people's accounts even more so than now. We looked at treasuries, and all we see is they closed this gap, got back up here, and found into resistance. They reversed today on the Fed purchase, but the Fed purchase didn't close. Closes on Monday. We know there's a rate cut coming. This is headed lower. And there we go with that. How about gold mining stocks? Remember, I was very excited about them and said, don't worry, there'll be a great time to buy them, but it's not yet. Look, it's reversed. All this gain for the most part, going back to people that bought in 2016, a few buyers in late 2016 and a few buyers in 2018. Expect this to go even lower. It'll be a monster buy when the time comes. That time is not now, so don't worry about it. Let's look at TLT because it's a nice chart to look at. You can see here's where all the sellers are at. And the buyers are under here, been buying under here. The Fed now come back in a big way into play on Monday and then on Wednesday. So I expect this to go way up and way past its all-time high. Remember, this is again, we're kind of looking at a weird looking bearish flag in the big picture. You can, let's go back. You can kind of see this flag. You see it go up and the flag kind of draping down. Well, you get this up and you short out you squeeze out all these shorts that are built into here somewhere, and then boom, this thing is off to the races. So let's cap things off at 45 minutes. Appreciate you taking the time to watch. I hope you learn a lot about how the interest rates work and the bond markets work, and why I believe and why I'm convicted enough, and why I want you as my client, and those of you who are not my clients but still watch this to learn something, to know why interest rates are really headed lower when everyone else thinks they're headed to lie higher. I'll see you Monday. I'm Steven Van Metre. Bye now. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. It shows not to be construed as recommendation or solicitation by selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. Please express the video that I'm on do not reflect the view of Alice Financial Advisors Inc. or Steven Van Metre Financial.